Well, welcome to our Leaders in Housing Counseling call. Summer's over and we are diving into the fall. So clearly going to be a busy time for all of us. So we're going to get started quickly on the agenda. We have, I think, a broad range of topics today. We're going to talk about what we're working on in Congress. There's a lot going on in Congress. We have a particular slice of this, and Matthew will walk you through the two big pieces. We will then have Josh Silver from NCRC to talk about the latest on the Community Reinvestment Act. And as we know, this is a vital piece of our work and the ability to really deliver credit, especially mortgage credit, into low and moderate income communities. And there's seems like a real push to constrain it in ways that will make our work less successful or bring less capital into the communities that we serve. So important for all of us to be kind of up to date, and CRC is one of the leading groups, and really the leading group kind of working in this area. So we're very interested in what they view as advocacy topics for this. We will then have Natalia Abrams and her, and really it'll be about the student debt issues and what's happened now that new administration has taken place, and they've been in place for a while, Betsy DeVos, and how it impacts repayment plans, and are there other issues we should be aware of. They will have kind of bring us up to date on both topics, and then also have a call that they're planning on advocacy that you'll be invited to as well. And then I'm just going to kind of do a teaser on possible solutions for around affordable housing, something that we've been paying a lot of attention to, and we'll bring in guests to talk about particular initiatives that we think are promising and counselors should know about, and hopefully things you haven't heard about and can take advantage of. We're very interested if there's other innovative things out there that are happening, so we'll, part of it will be a plug to see if you've got other ideas or tools that groups should be thinking about and using. And then we'll do our quick plug on joining NHRC. We've had a great year in memberships this year. Really appreciate how substantial. We're over 150 organizations are members now, and we've grown substantially this year. That's very helpful. You know, obviously there's a few housing counseling groups out there that haven't joined yet, so we're glad to encourage them to join. So we'll talk about that at the very end of the call. There'll be time for Q&A on all of these topics, so please feel free to use the box to communicate if you've got some thoughts or questions. And at this point, let me turn it over to Matthew to give us the latest on what's happening with federal funding.
Great, thanks, Bruce. So we'll just start with what's happening right now, which is FY 2019. There haven't been any changes in where things stand, but it's been a while since we've talked about it, so I thought maybe I would just kind of recap on where things are. So for FY 2019, interestingly, the Senate is moving along quite a bit faster than the House. It's usually the opposite. The Senate now has passed 9 of their 12 appropriations bills, including THUD, have moved all the way through the Senate. This is part of their push to do things through what they call through normal order, and it seems likely that they do have 9 of the bills passed. The last 3 that they have, I believe, are the more kind of controversial. Their goal is to get at least those 9 passed by the House and the Senate and signed by the President, and then to do a continuing resolution for those other 3. Just as a reminder, federal funding runs through September 30th, so things need to be passed or either continuing resolution or actual funding bills need to be passed by midnight September 30, or the government would be shut down again. So the Senate's moving along quickly. Unfortunately, folks will recall the Senate did cut funding for housing counseling to $45 million from the current level of 55. We did get not quite assurances, but some indication from folks in the Senate that their strategy was similar to what they did last year, where they took the funding out in the Senate bill and then replaced it when they went to the conference committee with the House. So moving over to the House side, it's a little bit strange, but the House Freedom Caucus, who folks will remember, the 40 or so really far-right House members, have decided that HUD is now a controversial funding bill. It used to be the case, certainly, that THUD was, one of the easier bills for them to do. They, because it funds things like, rental assistance and programs that, social welfare programs. They've decided that it's controversial. So it's unclear whether, when the THUD bill is going to move out of the House or how it's going to move through the House. It did pass through the committee. We were able to get a $1 million increase thanks to Congressman Young. But now, because the Freedom Caucus has decided it's going to be one of the harder bills for them to support, it's very unclear on how things are going to go through the House. But again, they need to either get a bill through the House and then conference with the Senate, or they need to do a continuing resolution, and that needs to happen in this month. So that's where things are for FY19. We have some work to do on the Senate side to try to get up from 45 to 55. A lot of that work is going to happen, in the conference committee. At that stage, it's the two THUD chairs and ranking members are really the ones that are going to be making those decisions, and that's where we're going to need to be pushing. But so we'll be in touch over the next few weeks as things unfold. We may be coming out with some asks for trying to push on FY19. But Bruce, did you want to add anything on 19?
Well, so just let's name names. So who are the conference committee?
So on the House side, it's Mario Diaz-Balart from Southern Florida, who's the chair, and David Price from North Carolina, who's the ranking member. And on the Senate side, it is Susan Collins from Maine and Jack Reed from Rhode Island, are the chair and ranking member, respectively.
So, to the extent that anyone is meeting with their House or Senate representatives or their staff, it is absolutely vital to ask them to reach out to those people, so House and Senate, depending on where you're located, and ask that they go for the $56 million figure in conference committee. So that's, to the extent that anybody can do any communication with their local offices, it's asking their leadership to, in the conference committee, to go for the full $56 million. And that will be really valuable going forward. Only a few weeks till the final the budget deadline hits. I guess we're expecting that it'll be there'll be a continuing resolution, right, Matthew?
At this point, I think that's right. There had been optimism that they were going to get, actual spending bills done, and the Senate did manage to do that. But I just haven't heard of anything moving in the House. They have some bills done, but it seems like they're getting bogged down. And I think the Senate is trying to put some pressure on the House to just pass the bills that the Senate has written. The House, a lot of times the House will include riders and all these things to try to keep, certain. The House caucus is pretty disjointed, and they'll kind of throw in perks for oftentimes to appease the kind of far right. I think the Senate's trying to pass their bills without any riders to put pressure on the House to do the same. But it's unclear if they're going to be able to do that. So, yeah, I think if you were a betting person, you would probably think it likely that they would do some sort of CR. And with the election coming right by.
Final letter.
So that's FY 2019. So then we also just wanted to get on people's radars for there's always two things happening at once. But for FY 2020, we're going to start that process now, actually. So in the past, we've waited. I think we've usually done it kind of late winter, February, March. We've done a letter to the Office of Management and Budget. They're the ones who are responsible for putting together the administration's budget that gets submitted to Congress. We've kind of decided under this administration to, rather than going to OMB, to go directly to HUD, to ask HUD to include us in the budget they send to OMB. So this is the first step of the process, is each agency puts together their budget request, they send that to OMB, OMB puts it all together, sends it to Congress. So we're going to do our letter asking for $65 million, and that's going to go to HUD. That's going to be either today or tomorrow. We'll send that out to folks. This is our big annual sign, or one of two actually big annual sign-on letters. So we typically have 3, 4. I think we've gotten as high as 500 groups signed on. We'll probably keep it open. I assume, we haven't talked timing, but probably for 2 or 3 weeks and really be pushing to get as many people signed on. This is our first chance to. We've been, for quite a while, been trying to get some significant increase in funding for housing counseling. We've had some success getting, some increases here and there. As we said, we got the $1 million increase. In the House version, we got a $2 million increase going a few years back. We had an $8 or so million. We've had some success at getting increases, but we've been really pushing to try to get, a significant increase. This year, we're going to ask again for $65 million, which would be a $10 million increase. And, we're going to make our best case for Secretary Carson and, the other senior HUD staff for why we think that housing counseling deserves that level of funding. But obviously, having a significant number of folks signed on would be very helpful. That's all I have to say on that. Anything to add, Bruce?
Nope.
Okay, so keep your eye in your inbox today and tomorrow, and I'm sure we'll send it out a number of times. All right, so then I just wanted to talk about another bill that's working its way through Congress. It's called the Reforming Disaster Recovery Act. It is sponsored by Ann Wagner, who's a congresswoman from just outside of St. Louis, the kind of western and southern suburbs of St. Louis. So this is a bill that deals with CDBG-DR. And the short of it is, folks, I think whether you've been through disaster or not, or disaster recovery or not, I think folks realize that the system is a little broken in that it's not designed to deploy resources, particularly in the form of funding, quickly and smoothly after a disaster. I mean, it takes many months before CDBG-DR, which is one of the more significant kind of disaster recovery. It's not the immediate response to the disaster, but it's that kind of medium to long-term recovery dollars. It often takes many months before those dollars are deployed. So the gist of it is this is a bill that would streamline and make it a smoother process to get CDBG-DR dollars out the door. So it's had a lot of support. It passed out of the House Financial Services Committee 53-3. So, obviously a broad bipartisan support. We did speak with some of the committee minority staff. They're actually optimistic that it will get a vote this year. And it's kind of unclear whether that's as a standalone thing or it might get attached to something else. But they're confident that it is going to come. We'll get through the House this year. On the Senate side, there's nothing out yet, but a few senators are working on something. There's also some things that could be improved on the House bill that the Senate side is looking to make some tweaks and improvements to. So we're going to start working with the Senate folks. We also have some suggestions on getting housing counseling included. So housing counseling is an eligible activity under CDBG-DR. So those dollars can provide for counseling for folks who've been through a disaster and need assistance kind of navigating the disaster recovery. But we're working on trying to get some specific language into the text of the bill as well. So stay tuned. So the House, again, looks like it something will happen this year. The Senate, it's unlikely that anything's going to happen this year. Perhaps impossible that anything's going to happen this year. But I think at least start laying the groundwork on the Senate side. So that is what I have on that. Bruce, do you want to add anything there?
Well, just really quick, just so that people understand, a lot of you have been working on disaster recovery, and sadly, many more will as things seem to be rolling out. Clearly, we've heard the message that the problem here is that the dollars flow much too far from when the disaster initially occurred. And so the idea is, can we do things that would get the money to be available? Not during the disaster, we're not first responders, but pretty quickly afterwards. As Matthew mapped out, the strength of the House bill is that it deals with lots of the procedural rulemaking that Congress had to do every time from scratch. This would make it a standardized piece. The one thing it didn't do was to set aside money ahead of time for this so that the money could flow more quickly. But we've heard that the word is that the Senate, they're trying to look about how to solve, which is a highly difficult problem, but important one. So this is directly relevant to a lot of your work, and we'll kind of keep you posted as we learn more and try to become more influential. There'll be some opportunities for people to lobby on this as well. Good. With that, let's do a quick turnaround. I see that Josh Silver has joined us from NCRC, a longtime veteran on the Community Reinvestment Act work. And so we were eager to hear Josh's assessment of where things are at in terms of the CRA and what role our counseling groups can play. So Josh, welcome.
Well, thank you, Bruce. And I appreciate the opportunity to address your organization and its members. This is very timely, and again, I'm very appreciative. There are 3 federal agencies that implement the Community Reinvestment Act. The Office of the Comptroller of the Currency, the Federal Reserve Board, and the Federal Deposit Insurance Corporation. And throughout CRA's 40-year history, the 3 agencies have traditionally moved in lockstep, in unison. There was a splintering in the mid-2000s, but that actually was corrected after a few years. Now there's a splintering again. The Office of the Comptroller of the Currency has made an initial step to go it alone in possibly changing the Community Reinvestment Act. And if they were thinking of good things, maybe we wouldn't care. Their notions of changing CRA are not so good. And why does CRA matter to housing counselors? Well, first of all, banks are analyzed under a lending test that looks at the number and percentages of loans to low and moderate income borrowers. So if banks want to score well on that test, presumably they would want to work in partnership with housing counselors to get people qualified to get home mortgage loans. Another reason why housing counselors should care about CRA is CRA looks at banks' investments, and a grant is considered a form of an investment because you're making a commitment, you're investing in an organization. Think of it that way. And grants under CRA can go to housing counseling agencies that serve low and moderate income people, and that counts on the CRA exam. So I think that's why it's immediately relevant to the audience that I'm talking to. And any weakening of CRA has the potential to significantly decrease lending to low and moderate income people and to decrease support for housing counseling efforts, very important housing counseling efforts. So the Office of the Comptroller of the Currency is led by now a Trump appointee, Joseph Otting, who used to be a banker. And it seems like his primary goal here is to make life easier for the banks. That's a normal human tendency. But in making life easier for the banks, we don't want to have fewer loans in low and moderate income communities. So one notion that he has is, let's make CRA clearer, that it's easier to pass, there's less anxiety. In and of itself, it's kind of a curious comment because the pass rate's been 98% over the last several years. But that seems to be what he is concerned about. And one way he is thinking of injecting so-called clarity in CRA exams is something called the one ratio. Can you boil down CRA to one ratio or one measure? And what he is proposing is the one ratio would be in the numerator CRA activities, the dollar amounts of grants and loans and investments, divided by, in the numerator, assets, or a measure of bank capacity. So if you have a $1 billion bank that is making $100 million of loans and investments, its ratio would be 10%. And presumably, higher ratios would get you higher scores on the test. Has some initial appeal, right? But why are we concerned about this? Let's go back to the origins of CRA, and CRA being a law that requires banks to respond to local credit needs, local community needs. How can a one ratio measure responsiveness to local needs if a bank operates in 5 or 10 states and 30 metro areas and several rural counties? In short, a one ratio really cannot reflect the performance adequately across all of these geographical areas, and needs differ in different geographical areas. Needs for housing counseling, for example, differ, and community input into the needs is a critical way for examiners to assess banks, and community input can influence a rating in either overall or in a particular area. The local geographical areas on CRA exams are those that contain bank branches, and they're called assessment areas. So the question, a huge question in the Office of Comptroller's initiative is, will the one ratio make geographical areas count much less on a CRA exam? We are not opposed to metrics on CRA exams, but we are opposed to one metric being determinative of the CRA rating. And by the way, I didn't do a good job in the beginning. The initial step here is called the Advance Notice of Proposed Rulemaking, and that has been issued by the OCC. They don't have specific proposed changes, but they talk about broad concepts in the Advance Notice of Proposed Rulemaking, including the one ratio. And they invite comments on all these concepts, and they have like 30 questions that we can respond to. Obviously, I can't go through all that in this phone call. But the comment period has started. It's 75 days, and the last day to comment is on November 19th. NCRC's webpage, and we have live a sample comment letter and a longer analysis. That's what I'm speaking off of right now. Let me just throw in a couple of other issues. I can't go through all the very important issues here. But another very important issue is what's going to happen to geographical areas on CRA exams. It's NCRC view that branches remain critically important for low and moderate income people to receive loans, to receive responsible loans. So assessment areas where the branches are must remain. But we know that banks, even before the era of the internet, were making loans through non-branch means, including through brokers. So in geographical areas where they're either doing a lot of lending through the internet or through non-branch means, those areas should also be assessment areas. And the OCC sort of suggests in the ANPR, if there's a state where there's a lot of lending activity or a grant making, you can kind of add those dollar amounts to the one ratio. It doesn't say explicitly, but it sort of hints at that. And that's not the way we want it to go. We want actually additional assessment areas designated so you can have community group influence on that. A couple of other things. The expansion of populations. CRA has been focused on low and moderate income populations. That's what Senator William Proxmire was concerned about when he was drafting the legislation and engineered its passage. Bank trade associations say, well, let's broaden that. If a hospital serves all populations, right? Well, if a hospital is an affluent part of the community, its utility for low and moderate income people is limited. So that's, and again, if you put that activity in the numerator of the 1 ratio, you're going to even further inflate the CRA ratings. There's other things, but I'm gonna stop now. I do have a hard stop at 1:30 because I got to talk to some other organizations about this. But let me stop now. There's more information on our webpage, and also let me give you my email, jsilver@ncrc.org. And let me take a few questions.
So I think the big relevant question is, what can people do to impact this?
Send in comments. We need to send in lots of comment letters. Depending how much time you have, you can look over it, you can study the ANPR and respond to the questions. Or if you this is important, but you don't have as much time, go to NCRC's webpage and look at the sample letter, tweak it. We encourage people to do some tweaks, and we suggest where you tweak it, and send it in. Let me give you the URL for the webpage. NCRC.
We'll send that out. So
okay.
Josh will send that out to the.
Yeah, I'll send it to you, Bruce. Yep.
Good. That sounds fine.
So yeah, sending in comment letters, talking to your colleagues about this is very important.
So I think one of the messages that advocacy groups have been saying is that it's important to personalize these messages to your local community, to take some element of this and really kind of do a deeper dive, and that the OCC and the evaluation process will need to consider all the elements here, and will need to respond. And so to the extent that we can really kind of force them to really deal with the issues that you're seeing locally, that relate to the Community Reinvestment Act, that's valuable. Is that a fair summary to say, Josh?
Yeah, I mean, get active, send in comment letters, make it relevant to what you do, and we have prompts for that, and I just sent you the URL where the sample comment letter is, and it also links up, and also our webpage also links up to the ANPR itself as well. And let us know if you have questions.
Excellent. Are we good? Okay, so Matthew says we're good. Okay, thank you so much. Keep up the great work. Let us know when there's more developments. And
absolutely.
Okay.
Thank you, Bruce.
Great. Yep.
Bye-bye.
Okay, so let's quickly pivot to student debt, and our friends Natalia Abrams and Cody Hunanian from the student.
We're just switching over. It's just going to take a second.
Good. Okay, good. So caught me up by surprise there. But glad to have you both here. Are you online?
Yes, I'm here, Bruce.
Thanks for having me.
Okay, great, good. Okay, well, we'll get the picture up in just a second. There we go. So let's turn it over to you and fill us in, please.
Thanks, Bruce.
Great.
And yes, we're from Student Debt, Student Debt Crisis. We are a 501c4 nonprofit focused on helping student loan borrowers understand repayment and advocating for better solutions. I'll switch it over to Cody, who's going to lead us off.
Great. So for those of you who have seen any of our information on these fantastic presentations by NHRC, you know that student loan policies are changes are being proposed at a breakneck speed. So we really just want to clarify things that are happening, things that are changing, and things to be aware of in the future. So if we go to the next slide, just to kind of give you guys a quick primer, if you haven't learned anything about the student debt crisis yet, this is an economic crisis. There's 45 million Americans with student loan debt. Certainly, many of your clients and those that you work with are impacted by this crisis. Together, those of us with student debt like myself, we owe $1.5 trillion. That $1.5 trillion is hurting the economy, and for your field, it's hurting things like first-time home ownership, family formation. So it really is impacting parts of the economy that are very far removed from education, but are truly important for the success of our country. And on that last note there, we've got 71% of current borrowers say their student debt is preventing them from purchasing a home. So, these are just the indicators of what kind of impact student debt is having. So, clearly it's a big issue, but what is happening now to kind of keep this issue developing? And that's what the next slide is about. So if we go to the next slide, I really want to give you guys a taste of what's happening at the Department of Education as far as policy changes and what we would define as major policy rollbacks. So first, there is a very important rule that was written during the Obama administration, and it's called borrower defense. Now, this rule, borrower defense, is often called borrower defense to repayment. It was a rule that was on the books for many years, but was rarely utilized. The point of this rule was to help borrowers who were defrauded by predatory practices at for-profit colleges. And what the rule provided was full student loan relief to victims that were defrauded by their for-profit colleges. Now, here we are. We fast forward to the current administration, and Betsy DeVos is using her leadership at the Department of Education to completely rewrite this rule that was designed to help borrowers. Now, the negotiated rulemaking process has just ended with comments being submitted, and the Department of Education has proposed their new rules, and that's what we really want to call attention to. So the new proposed rules for borrower defense would impact student loan borrowers in several ways. First, it would make it way more difficult for borrowers to apply to have their loans forgiven, because it would increase the level of burden of proof in which borrowers had to show that fraud was committed. So previously, if your school was a for-profit college that was shut down for fraudulent behavior, you could submit your claim as part of a group of claims and receive loan forgiveness. Now, if this rule is passed, borrowers who are defrauded by their schools will have to prove each case individually. On top of that, we're hearing that the department is proposing that borrowers have to be in loan default before they can apply to have debt relief for being defrauded. Now, that's putting borrowers in a situation where they have to choose to maybe ruin their finances even further for the opportunity to apply for federal relief. So all of these changes, as you can see, are things that are going to make it more difficult for borrowers who are defrauded to access relief. And just one particular development here that I think is notable, some of these financial choices, like having to default to apply for this program, will have real-world implications. Borrowers who are in default have trouble applying for mortgages and car loans. Those who work for law enforcement or the military could possibly lose access to restricted information or lose their job. So these changes aren't only preventing borrowers from accessing debt relief, they could actually hurt their lives. So this borrower defense rule, it is not put into place yet, but rulemaking has ended and the department is proposing their changes. So it is not the time to give up keeping pressure on, but it is quickly moving through the process, so I want to make you aware. Secondly, other rules that were designed to protect borrowers from the most predatory schools are being eliminated as well. There's a proposal to eliminate what is called the gainful employment rule. Now, the gainful employment rule sets a threshold where schools have to have a certain level of employment rates for their graduates, thus to prove that they're not just saddling borrowers with tons of debt and no job opportunities. So some of the most predatory for-profit colleges offer very little job opportunities, but have very expensive programs. Schools like that are held accountable under the gainful employment rule, and that might be thrown thrown in the trash soon as well. These are all developments being addressed in rulemaking, and so we will keep you updated. Finally, before I let Natalia take us into our next section, one other development that happened at the Department of Education that I think flew under the radar a bit. was the closure of an important unit that investigates fraud, particularly in for-profit colleges. And so you're seeing a thread here. What we're seeing is not only is the Department of Education taking away programs or attempting to take away programs that benefit student loan borrowers, they're also dismantling all of the tools the government has to hold the most predatory schools accountable. That is kind of the theme amongst all of these developments in the last couple of months. And so we see that as part of a larger agenda by Betsy DeVos and the administration to really deregulate the for-profit college industry at the detriment of student loan borrowers. And so with that, I'll pass it off to Natalia Abrams, who's going to jump into some of our more pressing developments when it comes to federal student loan repayment programs. Natalia, go ahead and take it away.
Thank you so much, Cody. And I think why this is important, it's to show that those borrowers, to piggyback on what Cody was saying, that deserved full relief. They went to schools that no longer exist. Their degree no longer counts. They were promised relief, and now it's being rescinded. So it's just showing this continued behavior we're seeing from the department to, favor financial institutions over students and borrowers. So we can go to the next slide. If you've been on previous calls with us or been, paying attention the last year and a half, the repayment programs, including public service loan forgiveness and all of the income-driven repayment plans, these are plans offered by the federal government for federal loans, have been under attack. We've seen attempts through the omnibus bill. There were even some attacks in the original tax bill due to the support of nonprofits, organizations like ours, NHRC. There was a lot of noise, and it was incredibly helpful. And we definitely saw these programs stay intact. And that's something that I want to be really clear with, because there's tons of misinformation, and also there are debt relief companies out there that try to tell students it's about to go away, you sign up now. These income-driven repayment and public service loan forgiveness, as of today, completely exist. We do suggest signing up people that are struggling to make ends meet or can't make their monthly payments. While we have been able to fight off the current attacks, we do see yearly with each budget from the Republicans and from Trump and DeVos, we see that they continue to go after these programs. So, we can't get complacent here. I do think it's due to the energy. Our members have taken over 25,000 actions, which means they have sent letters to their legislators. We strongly suggest that to talk to your, I think the last speaker said to talk to your friends, to talk to your colleagues, but also to let your leaders know, your legislators know that these programs are vital to making sure, as Cody mentioned, people don't fall into default. So, we have saved them for now, but because of what we're seeing with borrower defense or, taking away the Office of Students at the Consumer Financial Protection Bureau, or the head of the student section, the second in charge of the CFPB stepping down, we need to really be aware of the attacks to income-driven repayment programs. We can go on.
Just understand, Natalia,
yeah.
so we're so far, no damage has been done to the repayment plans. Is that correct?
That is absolutely correct. And that's what I want to make clear, that, borrower defense is something different that's specific to for-profit colleges, but things like income-based repayment, repay, pay as you earn, or public service loan forgiveness all still exist to date. We are also...
Well, let me just sort of follow up on this one other question here, because this is kind of vital to what the housing counselors work with.
Of course.
So what's the advice here? I guess a couple things. One is, if somebody has a payment agreement, that's for the life of the loan no matter what, right? So there's no going back on that.
So there are, unfortunately, in this climate, well, you have a standard agreement if you have your standard loan plan, and then you can enter into a repayment plan. We have heard through various very good sources that folks will be grandfathered in to their existing repayment plan if they were to change. It's hard in this climate to say 100% guarantee with the repayment programs, but for what we are hearing is yes, you would stay in the program that you were enrolled in.
And then what about the public service option? Could that be taken away and you're like 12 years in and you're out of luck? Or is that something that...
So we're hearing the same thing, but once you're in, and the way to get in, you can't actually enroll in the program. You need to fill out an employee certification form or employment certification form, and then make sure Fed Loan is your servicer. That's the only way to say you are a candidate for the program. For those of you that this may be, brand new language, we are hosting our monthly repayment workshop on September 29th. It's a Saturday. So if you're interested, we can send information on that as well to learn about all the ins and outs of the program. But we are hearing that if you... Go ahead, Bruce.
Well, if you would send just a summary on the public service option and what people need to do now. I mean, some of the people on this call are on that program right now or believe that they're eligible because they're working for nonprofits. Right. We should do, and certainly clients come in that situation. If there's a need to get people registered today that might not be registered in order to be able to capture the value of that program, we should really do a special push on this right now.
I wholeheartedly agree, Bruce. That's one of the, I think, messages we're trying to say is that, these programs exist now, and you don't want to wait. You don't want to think, I'll enroll in an income-driven repayment program next year, because there's no guarantee it will be there next year. And with public service loan forgiveness, you're right. Many people they just think they qualify, but they have not done the form to get onto Fed Loan as their servicer. And that's so vital because there's so many ways that you cannot qualify for. You can think you qualify for public service loan forgiveness, but that you won't. And I'll just do a very quick primer, which is you need the correct loan, which is a direct federal loan, which mostly was offered after 2010 or consolidated. You need the correct repayment plan and the correct job. So it's that trifecta, and so many people are unaware of that. So I'm happy to give information and even do a separate event for that, because you need to make sure you get into Fed Loan as your servicer, and you do an employment check and a loan check and a repayment plan check to make sure you qualify. So
this is all news to me. So I think we really it would be great to have some paper that we can circulate, and we can figure out if there maybe we should do a separate call around this in a few weeks. This is
and an invite to everyone. This is all covered in depth and on our repayment plan webinar, which is on the 29th of this month.
And Natalia, could you just let folks know, and I'm sure we'll circulate, but how they can participate in that?
Yes, sure. I'll make sure to get you a link.
Yeah, so what we'll do is we'll send after this. We'll send out an email with highlights, and that link would be critical to this. Perfect.
Absolutely. And folks actually can go to protectpslf.org right now, and there is, I believe, a tool that helps walk you through what you need for public service loan forgiveness, and we will include some paperwork. But if you just need to go now, it's there at protectpslf.org. Okay, well, with that, I think we can go to the next slide. That definitely covers the repayment programs and the need to enroll and be aware of what's going on. And we will continue to update all of you, all the folks at NHRC, if there are any changes to the plans. I think this last point is just to share the great work the Attorney Generals are doing, and also we work a lot with student loan borrowers themselves, and it's, feels very dire for them right now with the Department of Education not being on their side and the CFPB not being on their side. And so what the glimmer of hope, I feel, is what the state attorneys generals are doing. You know, there are borrower bill of rights on the books or in the works, which create protection for student loan borrowers from being taken advantage of by servicer abuse, debt relief companies, being able to have an ombudsperson to speak to. They're not all set up yet, but slowly we're starting to see the states take over where the federal government is lacking. I had the pleasure of introducing the Navient lawsuit with Attorney General Becerra here in California. He is suing Navient for misapplied payments, misleading students into default. If they were to win this suit, there would be restitution and money back for borrowers. So this is a space to follow because there may be some restitution down the line, especially because Navient, which you may know as Sallie Mae, while being the nation's third largest student loan company, is the #1 complained about company that is servicing our student loans. And our tax dollars are paying for that. So it's just something to keep in mind. Unfortunately, you know, right now, the Department of Ed is trying to use the preemption laws to stop the attorney generals. So they need to hear from you. We're in California, so we're personally working with Attorney General Becerra, and there's a link there if you know of any borrowers impacted by Navient. But it's just to really let you know that this is where and who we're turning to work with is both the states, but then state attorney generals in terms of finding and achieving relief for student loan borrowers. Moving on. I think that's it. We're happy to answer any questions, Bruce.
Great. Do we have any questions in the queue, Matthew?
One just kind of very general comment. Someone just said that it looks like the total, I think this is going back to the second slide, that the total student loan debt has gone down slightly in recent years. Is that accurate, or is it continuing to go up?
No, it still continues at about a rate of $100 billion per year. So we're at 1.5 trillion. I think there has been a slight decrease there. So there's been some of that in the news, just because we are seeing, not the same amount of droves as the millennials go to college, but we're not seeing the impact of how the crisis is getting worse in terms of more people. We had 1 million more people fall into default last year, and people trying to make their payment. So that overall big number is, important, but it definitely doesn't explain the whole situation.
Yeah, and if I could add to that, I think what that viewer may have tapped into, there was a piece, I think, that about a month ago that did claim that individual total student debt, so each person's student debt, had slightly gone down. But throughout our time researching this issue, what we've actually found is it's borrowers that don't necessarily have the highest loan balance that struggle the most. So that kind of research doesn't even begin to capture the true crisis that individuals are facing.
Great, thank you. And then we have a pretty specific question that I will ask, but maybe it might be something that might be like an offline answer. But the question is, if you're in bankruptcy, can you be denied financial aid? Can the school refuse to accept you under bankruptcy protection?
So I'm not clear on school accepting you or not. But if you are in default, which for student loans, not bankruptcy, because it's not called bankruptcy in student loans, but if you have default to student loans, you can not get any more financial aid. So that's on the default aspects of student loans. I'm not aware. That might be your wheelhouse more if you've declared bankruptcy.
Yeah, so I'm going to ask that person if you can follow up, and we can maybe get it. We'll figure out who to refer to, but I think it's maybe a little too specific for right now.
Yeah, if they wanted to reach out, though, there is some very time-sensitive default programs that they might want to look into. So they could always reach out to us via email, and we can try to point them in the right direction on default.
Someone said to clarify, and Natalia or Cody, if you can confirm this, that you're not eligible for financial aid until the loans are out of default. Is that accurate?
Correct. Your financial aid is, if you're in default, you cannot get more financial aid for you or your child if you're a parent, for like a Parent Plus loan, until your loans are back into good standing.
And then
and that's again default of loans and not personal bankruptcy with that, IRS.
And then they added that it will take 6 months of a rehab program or consolidate out of default to have renewed access to student loans.
Correct.
And that's actually
that's a 9-month program, not 6 months. It's 9 months of a fair and reasonable payment, which can be as low as $5 per month. And you have 10 months to complete it, meaning you can miss 1 month. You have either that option, consolidation, if you've just recently gone into delinquency and there have been no wage garnishments. But if they started garnishing your wages, your only option is to pay it off in full or to do rehabilitation.
Great. And I just want to add that this is a lot of the material that you're going to cover in the webinar.
On the 29th, yeah. Yes.
So I would encourage
folks. It takes
folks.
about an hour and a half. And we'll definitely, I believe Cody's going to provide you that link. And, we understand this is brand new vocabulary, which is why we do the same webinars monthly. So if you're not able to join us this month, sign up to our mailing list and we'll make sure to let you know.
Great. So definitely encourage folks that have these kind of specific questions on things to attend those. And this person just again wanted to clarify that after you've made 6 of the 9 payments that you are eligible again for financial aid. Is that?
I think what they're getting at is after, and Cody, you would be able to help me, after 6 months, then they are moved. The default status starts to fall off. Is that correct, Cody? I mean, they said to complete the program.
So the program itself, completing default rehab, is a 9-month program. There are some mechanisms along the way that will do things like strip the financial aid restriction while you're going through the program. But, I would warn any borrower who's hung up on that to just remember that they're not completely done and not back in good standing until they've completed that 9-month program.
And I know we'll cover a lot of this, but also you can only complete this program one time. So if you've already used it, you can no longer, you would have to then pay your loan in full. I think, we've discussed this with a lot of advocates. It's hard to remember and retain this information because a lot of it is just contradictory to common sense. So we understand how complicated this all is, which is why we do our own webinars as well.
Great. And I am going to, Cody just circulated to me, and I'm going to circulate to everyone the link to register for the webinar. And so then just the last question that we have is now very general, and it's basically if there's anything that can or will be done to help folks with student debt purchase houses. I mean, that maybe is a Bruce question, or I don't know if you all have thoughts on it. I mean, it's a very tricky question, I think.
Well, I'll let Bruce take over, but because I don't know the specific statutes, but I know that with talking with you all, doing research and income-driven repayment programs used to negatively impact student loan borrowers much more. There have been some loosening and more understanding of the bank and lenders for folks that are on income-based repayment plans, but maybe have decent income and decent credit. A great example is Cody, who's on the call with us, just was able to purchase a home while on an income-based repayment program. But I don't know the specific statutes that have changed, but I do know there has been a loosening in that and a better understanding. You just definitely cannot have a $0 payment for your income-driven repayment program. That will negatively impact you because that means that your income is incredibly low as well.
Great. Yeah, so we had Fannie and Freddie on last year around what their how they treated income payment plans in terms of back-end ratios. Maybe we should revisit that. We have a couple other conversations to have with Fannie and Freddie as well. So that's something to think about where things are at. I know FHA also has done some things.
Yeah, Bruce, I was just going to quickly summarize. I think we covered on our last update the loosening of the income-driven repayment plan restrictions so that your debt-to-income ratio and your monthly obligation looked a little better for mortgage applications. But there was one other thing that we talked about that I thought was interesting, which was the creation of some new refinancing and financial products that were specifically designed to help borrowers use their homes to pay off their student debt and things like that. So the industry is definitely responding to the growing student debt burden.
Though, of course, the problem there is if you do fall behind, you don't have the federal loan protections if you have a federal loan. Yeah, so it's maybe
correct.
Yeah. So at some point, maybe we'll do an update on kind of a refresher on all these issues.
Absolutely.
Covered a lot of good ground here. Thank you so much for your excellent work. We're almost at the hour here. Let me just quickly finish up a couple things. So on the we are going to launch a series on kind of solutions for the affordable housing crisis, about affordability. And the idea is, are there new ways to think about down payment? Are there new ways to think about how to structure loans? Are there new ways to think about rehab? Are there new ways to think about new construction that can help bring down the overall cost burden to the home buyer? And I mean, it's when I travel around the country and we do these events and have meetings, it's a constant refrain that it's very hard to find affordable properties. The affordable properties that are available are often bought up by cash buyers who are interested in either flipping or converting the house to a rental. That property prices have gone up substantially and often out of the range for low and moderate income buyers, except for a few places in the country. And so what we're trying to do is kind of harvest the sort of some of the big and small things that are being done out in the field that could help us help create more homeownership opportunities. And it's part of this whole bigger concern we've got that levels of homeownership are down in this country, but very much down in communities of color and especially in the African American community. And so I think we kind of have an obligation in all our work. We obviously are on the front lines of these issues, but to the extent that we can take advantage of every tool out there. So if you've got some things that you've found in your field work that you think would be useful in this, please shoot me an email. We've got 3 or 4 things we're going to push out this fall, but we're very, very interested in more to do. We will also do the Innovations in Housing Counseling series, probably starting in the beginning of next year. So if you've got a project that you'd like to get featured and get a lot of recognition for, and not just the housing counseling community, we do circulate these things to funders and to policymakers and thought leaders. So this is an opportunity to get a little bit of recognition for your good work. So please shoot me an email if you think that you've got. For Innovations, this is a series that's about new lines of business for housing counseling agencies that can generate new income, but are still deeply within the mission of what housing counseling groups should do. And I'm going to circulate last year's list shortly, so you can get a look at what we've done, and also I'll explain how you can easily go back and listen to some that if you're interested in, if you missed them and you'd like to hear about how they work. Okay, so with that note, we'll quickly finish up. Just want to remind people becoming a member of the National Housing Resource Center, fairly easy. Go to our website and click the membership button. Actually, there's 2 clicks to get into the membership application, or you can just send me an email, and I would be delighted to send you the application and what the cost schedule is. This has been really valuable work for us. We're very pleased to find out that the discount on the credit reports has worked out a lot for organizations, and the good news is people are telling me that they're saving hundreds of dollars. A few groups have said they've saved thousands of dollars, so I'm delighted to hear that. That's part of why we exist, to try to do more of these kind of things. We're starting a conversation about insurance, see if that's one that we can be helpful as well. So, I mean, these are all possibilities that we'll be working on. So please consider joining if you haven't already. And big thanks to the many, many groups that have joined. And we should post what the most recent list is, because there's been a lot of additions. Good. Well, with that note, we'll be back in 2 weeks on the 20th with a whole new roster, and be talking about a whole different set of issues. But please, between now and then, while you're doing good work, we'll shoot out both notices about the meetings and other activities. Keep an eye out for Matthew's email on the sign-on letter, which we'll try to circulate soon to get the HUD on housing counseling funding for 2020 for the year ahead. All right. Thanks so much to everybody for your good work, and we'll be in touch.